Heads up, stock traders and investors. We've got a critical stock market alert here that you definitely don't want to miss. The benchmark S&P 500 index, represented by the SPY ETF, has just triggered a bearish signal of long-term trend for the first time in 7 months after slicing through critical support of its 200-day moving average. The 200-day moving average is a simple but highly reliable indicator of long-term trend that both the S&P and Nasdaq were stuck below throughout the 2022 bear market. The major indices finally reclaimed their 200-day moving average in March of 2023, which kicked off a multi-month rally in the stock market. But now, SPY has convincingly sliced back below its 200-day MA, and it's done so for the first time since March. So does this hint at another bear potentially lurking around the corner? If so, what about the Nasdaq? Will the Nasdaq's relative strength save the market? In our new video, we analyze key intermediate and long-term trends and patterns of the SPY and QQQ to see what the charts say. Specifically, we'll dive into the pivotal support and resistance levels that could guide the market's next move. With technical signs of potential trouble on the horizon, your portfolio cannot afford to miss this crucial stock market update. Before we dive in, remember to press the like button and subscribe to ensure you don't miss out on any other future stock market updates. And as always, remember that everything we say in our videos is not financial advice. It's simply our interpretation of what the charts say. This is a snapshot of what stocks looked like as of the time of our last video. And we mentioned in our last video that QQQ was stuck between a rock and a hard place, dancing the fine line between resistance of its downtrend line and support of its 50-day moving average. And at the same time, we said that SPY was displaying relative weakness, stubbornly staying stuck below its 50-day moving average and flirting with a potential dip below the 200-day moving average. In this major market divergence between the Nasdaq and the S&P 500 had traders on the edge of their seats. And we left you in that last video with a crucial question. Which would happen first? Would the Nasdaq break free and break out above its downtrend line, pulling the rest of the market with it? Or would the S&P 500 break down below its 200-day moving average and bring the Nasdaq back down with it as well? Well, let's fast forward to now and actually see what happened. Well, it looks like scenario 2 has come to pass, with SPY taking a tumble and plunging not only below its 200-day moving average, but also below its 50-week moving average, which we'll show you here shortly. For those of you who've been in the trading game for a while, you know that breaking through these long-term levels is no small feat. So let's take a closer look at the S&P 500 chart, and then we'll take a look at the Nasdaq thereafter. Now, in today's video, we want to focus more on the intermediate and longer-term trends of the market so that you can devise a smart plan to safeguard your long-term investments in case the market continues lower. So we're not going to focus too much on the shorter-term trends and the 8 and 20 period moving average like we typically do when we're looking for swing trade setups. Instead, we'll focus on the intermediate term trends using the 50-day moving average, this red line, and the 200-day moving average, which is our yellow line. So with MTG, we do kind of a top-down analysis when we're looking for potential trade setups, which means we look at the longer-term charts, the big picture trend first, and then we drill down to the shorter-term charts. So that being the case, let's go ahead and start by zooming out to the weekly chart, and then we'll take a look at the 50 and the 200-day moving average on the daily time frame. So let's go ahead and look at the weekly chart first. Each bar you see here represents a full week of price action. So on this chart, we're going all the way back to the beginning of 2020. So when COVID kicked in, we had that big sell-off right when COVID first started ramping up, and then we got actually a rally when the stimulus started kicking in and so forth. So we can see here that was the period we're looking at back here, was that sharp sell-off followed by a sharp rally in the beginning of 2020. And let's take a look here at the big picture of what's been happening since then. This red line is the 50-week moving average, which tracks similar to the 200-day moving average, but not exactly the same. And we can see that after the bullish reversal in early 2020, we got back above the 50-week moving average in June of 2020. And we stayed above that 50-week moving average for basically a year and a half, right until the beginning of the bear market in January 2022. And then when we entered into that correction, which wasn't surprising given the amount of the gains we had preceding, so it wasn't surprising to have a bit of a correction. But when we entered into correction mode, notice how the price slipped below that 50-week moving average. And then we tried to rally back above that 50-week moving average in March, couldn't get above it. And then we tried again to rally back above it in August of 2022, and it acted firmly as resistance. Price fell back down. And then we tried to get back above it again in November 2022. And finally, on about the fifth attempt, we popped back above the 50-week moving average in March of this year, is when SPY reclaimed its 50-week moving average. So you can see that the 50-week moving average was a very pivotal level for long-term trend. And we were trending above it steadily higher. And once we fell below it, that support level became resistance. Remember, one of the most critical components of technical analysis is simply understanding that a prior level of support becomes a new level of resistance after the support level is broken. So after the price fell back below this 50-week moving average, that 50-week moving average now became resistance. And you can see clearly how the 50-week moving average acted as resistance. And then when we pop back above it in March, technically this 50-week moving average now becomes support. But here's the kicker. We've slipped back below that 50-week moving average. And it wasn't just barely below it by like 0.5%. We closed firmly below it. So it is possible, of course, that SPY could snap back above its 50-week moving average, and it would be positive if we closed this week back above the 50-week moving average, because that would just be an undercut scenario, one dip below it. But if we don't close this week back above the 50-week moving average, then we could have a new longer-term downtrend setting up like we had throughout the year of 2022. We also can spot kind of a trend line that developed off of those lows of 2020. If we draw the trend line connecting with the lows of 2020, then we can connect here with the low of October 2022, and then again with another anchor point in March of 2023. And connecting that, drawing that trend line, we see that, notice how the trend line basically had confluence with the 50-week moving average and lined up almost exactly with that 50-week moving average. So we've sliced through not only the 50-week moving average, but also an uptrend line that's been in place for 3 years. Now, granted, there is only a total of 2 touches of that trend line, so it's not a real well-established trend line, but nonetheless, it is a trend line. But what's more important here is simply looking at the moving averages and the 50-week moving average in particular. Now, let's go ahead and zoom into the shorter-term daily time frame and see what the daily chart looks like. And we'll go ahead and remove that drawing just to make it easier to see what's going on here. And so now you're looking at, on the daily chart, going back to the beginning of 2022. This is the start of 2022. So as soon as we slipped below that 50-week moving average, we also fell below the 200-day moving average. And that 200-day moving average became resistance. And notice how we popped back above it, a couple days, couldn't hold, and fell back below. Here again, perfectly acted as resistance on that rally. We set a lower low and set a lower high. Notice, by the way, that we've set throughout 2022, the market just kind of moved in waves. We had 1, 2, 3 lower highs, and we had at least 4 lower lows. 1, 2, 3, 4, 5 lower lows and 3 lower highs that set up on the daily chart throughout the 2022 bear market. And then finally, we set a higher low and a higher high, and that's when the bear market reversed and the price got back above the 200-day moving average. And that's where the price has stayed since March. From March until last week, we've been above that 200-day moving average, but last week we sliced through it. And initially, after the S&P sliced through that 200-day moving average for one day, the market did try to bounce and reclaim that 200-day moving average. You can see that green candle right here, but traders sold into that move the next day, and we convincingly fell back below it. So we did initially try to hold up with this undercut scenario, but now the price action is well below that 200-day moving average. So what does that mean? Well, it's too early to say at this point whether or not we're entering into a new bear market. However, it's definitely a warning signal, a shot across the bow, the fact that we're back below the 200-day moving average. But of course, we could do a scenario like we saw here back in March where we dip below it for a couple of days or a week and snap back above it. So it's very important to watch this level in the coming weeks. Watch this 200-day moving average and the 50-week moving average closely. Currently, it's at the 423 level. the 200-day moving average. So you might want to set an alert on your TradingView charting platform to notify you if the price action gets near or back above. If you have any long positions that you're stuck in, you may want to consider selling into strength on a bounce that tests the 200-day moving average, especially if it fails. And likewise, we wouldn't want to be looking to enter new long positions for anything more than a quick bounce unless we would break out above resistance. Okay, so let's take a look at where we have resistance. So for resistance, first of all, we've got the 200-day moving average. Obviously, we just mentioned that. That's a crucial level. But before that, the S&P 500 is first going to have to test its declining 8-day exponential moving average. That's this green line, which is going to act as short-term resistance on a bounce. So we can see the market's health based upon how the price action acts when we run into this 8-period moving average. That's a very short-term indicator of trend. So if the S&P cannot even get back above this 8-period moving average, that would be a bearish signal. So keep an eye on that level as well, currently right at the 419 range. And notice how it has crossed below the 200-day moving average as well. So we've got more resistance if we get back above the 200-day moving average. We've got the 20-day exponential moving average around 425. So this whole range here, basically 419 to 425, we could just kind of draw a little horizontal box here because that whole range is going to act as resistance for us on any bounce attempt. So that's kind of a target area to look to potentially sell any positions that you don't want to hold through potential correction that could get steeper. That could be an area to sell into. Also in the MTG chat room and with the Wagner Daily Service, we're trend traders. So when we're in an uptrend, we're looking to buy stocks with relative strength that outperform the market. But when we shift into a downtrend, a confirmed downtrend, we either sit in cash and protect our profits, or we also look to initiate select short positions and look to profit from downward moves in the market. So we'll be keeping an eye out, depending on price action. If the S&P rallies and stalls, that could create some potential short opportunities as well. If we do get back above the 425 level, then that pesky 50-day moving average is going to confront us as well. That's currently at the 435 level. And notice how that 50-day moving average has been resistance since August of this year. We slipped below that 50-day in August, tried to get back above it a week, like 2 weeks later, only held above it for 4 days and fell. And now that 50-day moving average has firmly become resistance. And just a few weeks ago when we tried to bounce, that 50-day moving average acted as resistance, and we've now formed 2 lower highs on the daily chart and 2 lower lows. So the SPY is already in an intermediate term downtrend, and the break below the 200-day MA just kind of confirms that. So we've got all kinds of resistance. But what about support? Well, we've already broken below all of the key moving averages we follow in the daily chart. Now, if we zoom back out to the weekly chart, we'll see that the 200-week moving average, this yellow line, acted as support in October of last year, basically almost exactly a year ago, which pretty much marked the lows of the 2022 bear market. And that's currently lining up right around the 393 level. So we could expect to find some support if we continue lower. We could see a significant bounce on a test of this 393 level. When we're trying to anticipate where the market may find support or resistance on an intermediate or longer term level, in addition to moving averages and trend lines, we also find that the Fibonacci indicator works very well for predicting retracements. Now, we could make a whole separate video on Fibonacci, which we're going to be doing here in the future, but suffice it to say that the main thing you need to know is the levels that the market can pull back to based upon Fibonacci. And this is the Fibonacci indicator that I've drawn. And what I've done here is I've drawn Fibonacci from the bottom of the bear market, the 2022 from October, to the high of the bounce throughout this year, which was in July. And that's from this level. Now we look and see how much is the market retracing. And the main Fibonacci levels that we look at are the 0.382 retracement, 0.5, and 0.618. So these are percentage retracements of the range from the low to the high. And the general concept, if you're new to technical analysis, is that the more the price retraces off the highs, the less likely the price is to go back up to those highs because more people get trapped at higher levels, which causes more overhead supply, and it becomes a self-fulfilling prophecy that builds on itself to make the prices move lower. So that being the case, if we take a look right now, we can see that we've just broken below the 0.382 Fibonacci retracement level, or 38.2% Fibonacci retracement level. Notice how well this Fibonacci works, by the way. the 38.2% retracement level lined up right here with these prior highs of the base before we broke out. So those prior highs were resistance. Now that acts as support, but we did slice through that support level. But that's exactly where we'd want to find horizontal price support, and Fibonacci accurately showed us where that is. So the next level where we're going to find some support is at the 50% Fibonacci retracement level, 0.5, which is currently at around 403. Notice how that also lines up here with these prior swing lows before we broke out of this base, just above the 50-day moving average. So we can expect to find some support right around the 403 level. And in addition to the 200-week moving average being at 393, we've got the 0.618 Fibonacci retracement level right around 391. General concept here is that it would be great if the S&P 500 finds support at the 50% retracement and doesn't go any lower. General concept here is that if the SPY gets below this 61.8% Fibonacci retracement level, then odds are pretty good that it will retrace the entire move lower and we'd see a retest of this 2022 low. So we definitely don't want to see SPY break below this 390 level. By the way, let's go ahead and zoom out to the very long-term monthly chart, because I was just analyzing charts recently and I saw this long-term indicator that I wanted to show you. So we're going all the way out here to the monthly chart time frame. So each bar you see here represents a full month of price action, a very long-term chart. And what you're looking at here is going back all the way to 2009. All right, so this is basically the past 14 years. And what I want to call your attention to is this red line, which is the 50-month moving average, very, very long-term indicator of trend. And you can see that we've been above that 50-month moving average since basically 2011. So for 12 years, we've been above that level. And we only dipped below it one time during that entire move, which was back in March. Again, the start of the low of the COVID levels in March 2020. And we only dipped below it 1 month and snapped back above it. But what I want to call your attention to is notice how we actually bounced off that level last year. And that was the lows of the bear market. But we're actually nearing that level again. And each time that we touch this level, the support level is going to weaken. So we don't want to see a lot of touches of this level. And if we actually slice below this 50-month moving average, if we don't snap back above it pretty quickly, things could get ugly. Last time that stocks stayed well below the 50-month moving average was all the way back in the 2008 financial crisis. And at that point, once we slipped below the 50-month moving average, the S&P went from 131 all the way down to a low of about 68. So that was nearly a 50% drop over the course of about 7 or 8 months after slicing through that 50-month moving average. So certainly not trying to be a scaremonger or create any kind of panic or fear, but I just want you to be aware that if we break below this 50-month moving average, it could get pretty ugly out there. And, it's really important to trade what you see, not what you think. Okay. At MTG, we don't rely on news events. We don't care what's hot on social media, on TikTok or Twitter or X, whatever the case may be. We focus purely on technical analysis and what the charts are telling us. So again, this is just one possible scenario. Anything could happen. We may rip to new highs. We have to be prepared for any possible scenario, but we want you to be prepared for this potential scenario where if we break below that 386 level, that means we're below the 50-month moving average, and that could be pretty ugly. So just keep that in mind and keep an eye on this level in the coming weeks. Now we'll take a quick look at the Nasdaq, but we really wanted to focus our attention primarily on the S&P 500 because it's a broad-based index of 500 different stocks, which kind of gives us an overall picture of the stock market's health. But let's go ahead and see where the Nasdaq is at as well. We'll just go ahead and stay on the monthly chart since we're already on the monthly time frame. And you can see with the Nasdaq QQQ, pretty much similar to what happened with SPY back in 2008 when we broke below that 50-month moving average. SPY basically almost got cut in half as well. And it's been above it since then. And again, we had a 3-month, basically a 4-month test of it with the lows of the 2022 bear market. And we're nearing that again. Notice, of course, that not only with QQQ, but SPY, we've set a lower high, significant lower high from last year. And that's pretty notable. So for the QQQ, this 50-month moving average is currently at 304. Keep an eye on that level. And now we'll go ahead and zoom in to some of the shorter term charts. So we've got the weekly chart. QQQ is still above its 50-week moving average, unlike SPY. So definitely the Nasdaq 100 has been showing relative strength, holding up much better than SPY, still above its 50-week moving average. And you can see we're still above horizontal support as well. This was the breakout level when we broke out above the high of August 2022, and we're still above that level, which actually shows confluence with the 50-week moving average. So keep an eye on the 332 level in QQQ. We could get a nice bounce if we come into that 332 level and hold, because that's confluence of the 50-week moving average and the prior breakout level. And that bounce could also potentially cause the S&P 500 to rally as well. So we're going to see very closely how the rest of the market performs as QQQ nears a potential test of this support level. Now let's go ahead and take a look at the daily chart. On the daily chart, we do see that QQQ is still above its 200-day moving average, unlike the SPY, but it is very much nearing a test of that level. Currently only about 6 points above, about 2% above the 200-day moving average, right currently at 339. And you can see, just like SPY, that the 200-day moving average was in play throughout the 2022 bear market. After QQQ fell below it, it acted firmly as resistance until we popped back above it earlier this year, but we're still above it. So keep an eye on that level. In terms of Fibonacci retracement support, notice how the 200-day moving average perfectly aligns with the 38.2% Fibonacci retracement. That's pretty cool, right around the 339 level. You'll see that happens a lot, where moving averages and prior levels of support and resistance line up with Fibonacci. And that's the amazing thing about Fibonacci. In fact, it works not only in the stock market, but Fibonacci is all over nature and the universe. If QQQ breaks below the 200-day moving average at 339, then we could find some support right around 324 is the 50% Fibonacci retracement. And then the critical support is at 309 of the 61.8% Fibonacci retracement for QQQ. In our last video, we also talked about major relative weakness in the small cap arena, and specifically the Russell 2000. You may recall in our last video, we mentioned about this head and shoulders pattern, left shoulder here, right shoulder here, the head, and how we broke down below the neckline of this bearish head and shoulders pattern. And that's really what's been weighing the market down, is small caps, because when small caps are weak, it's very difficult to have any type of a significant rally in the market, because the performance of small caps is often an indicator of the amount of risk in the market. When people are getting risk averse, funds typically rotate out of small caps and into more of the traditional blue chips. And you can see here that IWM, the Russell 2000, has just been getting blasted, just trending lower nearly every single day. And in fact, if we look at the weekly chart, we'll see that the small cap index is right at a pivotal long-term support level. IWM basically closed right at the 162 level, which was the prior lows from the bear market. So while we've got the S&P 500 and Nasdaq still above its lows of the 2022 bear market, IWM is already at the lows and about ready to potentially break down below those lows. So keep an eye on small caps if you want to know where the S&P and Nasdaq are headed when they bounce. The performance of the small caps could be an indication. If small caps suddenly wake up and start to show relative strength, that could be a leading indicator for the rest of the market. But for now, all we're seeing is small caps continuing to get hit and now testing a major support level. A break below the lows of the 2022 bear market could have negative implications for the overall market. We hope you found this video to be enlightening and helpful. Be sure to make note of those key support and resistance levels we talked about, in particular on the S&P 500, which is leading the way lower along with small caps. And if you're new to MTG, head on over to morpheustrading.com, and right on our homepage, just drop your email and you'll receive daily top trade ideas for swing trading, as well as powerful market analysis like you see here. See you back here in our next Morpheus market video.